Hello listeners, welcome to Money Talk with Patrick. I'm your host Patrick, trading mentor and creator of TC Trading. In today's episode, I would like to talk about the best way to grow your wealth. This episode will be especially important if you are a young adult and are starting or growing in your chosen career. I will be mentioning some tips which will be helpful no matter what your chosen career is or how much you are earning. If you find the content of this episode useful, please share it to your family and friends. It really helps me reach more people and help others. So hello everyone, how are you doing? I hope that you are having a nice week. So let's talk a little bit more about how to grow your wealth. And before starting to talk about investments and how really you can start growing your wealth, it is very important that you have a financial plan. Okay, and I cannot stress this enough because for the ones of you who have done my course, hopefully you will remember the following, which is if you fail to plan, then you are planning to fail. Okay, so it does not matter what you're doing if you don't really have a goal, if you don't have a brief or at least vague understanding of what you have to do. Chances are that you are gonna be failing or you're gonna be wasting your time trying to do things that might not benefit that long-term goal. Okay, so basically the name of the game is understanding your cash flow. What's cash flow? It's understanding how much in terms of money goes into your accounts and how much goes out. Okay, understanding that cash flow. Now, this will depend, of course, on your specific situation, and you will have to do your own research and analysis to come up with the following estimates, what I'm gonna be talking about. So, first of all is understanding your costs. Okay, this might sound silly, and you might say, yeah, of course I have costs, right? And I know what they are, but this is really more about how much you are spending per month and really understanding on what, because most of the times or a lot of the times people will have subscriptions for different things, or they will just pay for different things and they will not really understand, or they will not really know what they're really paying for. They will only see a bill at the end of the month and that's it, right? But maybe they don't really understand that they can actually reduce those costs. So in order to make it easier for you, what you can do is to categorize your costs. Now, if you use let's call it a top-down approach, talking from the broader perspective, there's really two big categories you should understand. The first one is needs/obligations and luxury/non-essentials. Now, for needs, the obligations, you have your typical payments that you have to do. It's not that if you want to, you have to do. You have to pay for your rent. You have to pay for the different bills. If it's water, if it's electricity, if it's gas, if it's even your Wi-Fi. Right now, internet is something essential, right? Transportation, groceries, food, all of these are needs or obligations. They're basically the fundamental things that you need in order to live and potentially build your wealth, right? And now talking about luxury/non-essentials, I mean, this is very easy. This is pretty straightforward. If you are having nights out, if you are having takeaways, deliveries, if you have hobbies, things that, all of these are things that you want. Really, it's not that if you don't pay for them, if you don't have them, it's not that you're gonna die. It's not that your livelihood is really gonna be affected. Of course, maybe you're not going to do something that you really wanted to do, but you probably can live without that. Now, it's also important to take into consideration non-predicted costs. What do I mean by this? Like if you lose your phone, something in your house get damaged, your pet just destroys something. I hope you get the idea, but it's just this type of costs that are not overwhelmingly big. They're not gonna destroy you financially, but yet there are things that you are not predicting. Now, it's time for wealth distribution. Okay, So once you understand your costs, you will be able to optimize them and get rid of the costs that you might not need or could potentially reduce. Okay, so maybe you are paying for 5 subscriptions of, I don't know, Netflix, Hulu, Disney Plus, whatever. Maybe you don't need all of them, right? Maybe if you understand that they all are pretty much the same, then you can reduce most of them for some months. So maybe you just go with one, or maybe you go and do as a lot of people and just watch videos on YouTube and save all that money. In any case, having done all of this, then you can subtract your costs from your total income, and this will give you kind of like a surplus that you should distribute in 3 main parts. As you might guess, maybe you are already doing this, maybe you already have this, maybe you don't, but the most important part is to have an emergency fund. And as you might expect, this is to tackle any non-foreseeable events. And when I'm talking about non-foreseeable events, I'm not talking about like before that you have non-foreseeable costs, like breaking something. I'm talking about big events that might really change your lifestyle, like losing your job, termination of your lease, or any other major costs that you cannot realistically just pay with one single month of whatever income you have, or the surplus more than anything. So usually the amount of your emergency fund should cover at least 3 months and up to 6 months of your monthly expenses. Okay, so this is very important. And now this of course will depend on you, how conservative or how aggressive, but usually you should not have any less than 3 months, because even 3 months, it's still very low, having seen what happened with a recent pandemic, with all of this COVID. That it's important to be prepared just in case. In any case, remember that this amount is something that you will have in an account just in case you should need it. You will never use it unless it is strictly necessary, unless you don't have any other option or realistic option, because you don't really want to go into debt. You don't really want to have a negative funding. In that case, you really want to use that if necessary. So once you have this emergency fund, this emergency fund is settled, you want to divide the rest into savings, meaning specific goals that you have. Maybe you want to buy a house, maybe you want to buy a car, whatever it is, you have a goal, you can use this into savings, right? And apart from that, you're also looking into investments. So you are gonna divide it basically 50-50, or at least this is what a lot of the people do. Of course, it might depend on you. Maybe you have, I don't know, a specific financial goal. Like I said, you want to buy a house, you want to buy a specific thing that you've been wanted. Maybe you want a trip to holidays, so maybe you're gonna be like, okay, I'm gonna put 70% into savings because I really want to reach this, and then 30% into investments, right? That really depends on you. That's not something that anyone can tell you. But in any case, after this is where all this due diligence comes. Okay, now that you have your financial plan, it is time to start doing your research on the markets and what you would like to invest in. Now, the easiest thing and you might read this from other books like Unshakable by Tony Robbins. A lot of people, mention it. It's kind of like very basics, is to check index funds and also ETFs. You usually check them first because they are managed by professionals, and they pretty much do all the work for you. You just really put your money and then you just hold, right? You don't really have to worry, oh, is it going up, is it going down? Should you change any what's called tactical asset allocation, meaning changing the different percentages of your allocation? You don't really need to worry about that. They're gonna do that for you. Now, index funds are basically managed funds that try to track or mimic the performance of different indices like the S&P 500, the Dow Jones. You can name anything. In any industry there might be a specific index or indices that you want to track. Now, ETFs, on the other hand, are exchange traded funds, and they can really vary depending on the manager and their investment style. So you will find a lot more, maybe some of them are particularly focused on tech, maybe others on the financial industry. So again, you might want to do your own due diligence, do research, and just invest in what you think might be best for you or what you really like. Now, of course, if you're listening to this podcast, if you have done my trading course, you might be more interested in DIY or doing it yourself, right? You can always look for different stocks and shares of your interest, cryptocurrencies, of course. Even long-term investments like bonds will help you again in the long run. Now, remember, investments are for the long haul. You are at least looking at the following 5 years, and I cannot stress this enough, and I will be talking another episode of my most important lessons throughout last year, but really it's very different to have your investments from trading, right? So your investments, you should not touch them. That's something that should be for the long term, and you should not again liquidate them unless you really need it, or maybe you think that the market is really oversaturated and you want to maybe buy a house, maybe buy some assets, right? You don't really want just to spend them in something that you don't need. Mainly it's like your investments are growing and you notice that maybe you want to redistribute that wealth into something else that might potentially make you some money. In any case, once you have your financial plan, once you have done your due diligence and know where you are going to invest your money, it is time to execute the plan. So how do you go on about this? The best way is to place that monthly allocation of investments, okay, that we have talked about before, and just buy the assets you want, disregarding of the price, okay? And this for the ones that of you that have been into trading or done trading, this might sound a little bit controversial, but of course, please bear in mind that it's very different to take this as a look as investment versus trading, okay? Now, doing this, it's called dollar cost averaging. And what it basically does is to average your entry price throughout time. So it does not really matter if the market goes down, if the market goes up, if it goes sideways, you will always be investing, okay? Now, in the long run, this is the best strategy because it will expose you to the best performing days and give you an opportunity to invest when the markets are tumbling and are going down, right? So if the markets go up, of course, you're going to benefit of that increase in price. But if the markets go down, you are going to be able to invest monthly, and thus that price or your entry price, it's going to go even lower. So the next time or the next cycle, you will still have more money or more profit, okay? So that's the idea of this dollar cost averaging. In any case, it is very important, again, and I'm stressing this because it is one of the lessons that I learned through last year, is that it's very important to remember that you are investing and not trading. Thus, you are not trying to time the market, okay? So if you have something that's for the long term, don't try to just sell and buy again. There's no point in doing that. If you want to do trading, and I'm gonna be talking more about in another episode, you should need to consider it as an active income, okay? It's not really a passive income. Investments are passive income, but well, that's really a whole other episode. In any case, traders and listeners, I hope you enjoyed this episode of Money Talk with Patrick. I hope that you have learned something new that you can apply to your daily life. Having a plan is very important, and you should always do your due diligence or reach your financial advisor in case you are not fully aware on how to tackle your specific situation. Once again, before finishing this episode, if you learned something during the episode and you think someone else might benefit from it, mind sharing it. It is really appreciated. Thank you very much for listening, and I will see you in the next episode. Take care.